Hello everyone, this is Hao Zhong, the presenter for Translation Exposure about the debt between United States and China. Every time when we talk about the debt, the enormous amount of debt, a concern that a lot of people have already thought is China's ownership of United States government debt a national security threat? By the beginning of 2014, China reached an all-time high record that has more than 1.3 trillion of the United States government debt. Consequently, public press and all media began to pay close attention to the existing situation. Firstly, we have to talk about why China has so many treasury holdings. Short answer, because of trades. American companies put money in the short-term treasury notes and bills to settle payments into international business. China's government bought securities and holds so many treasury bonds to gain value, not for losing value. If American economy collapsed, all debt will turn to another way that is far from an intellectual investment. Secondly, let's do some mathematics. United States has 16 trillion in outstanding debt that has issued. The total amount that China's government holds is approximate 8%, only 8%. In other words, most of the debt is held by American company. Moreover, the bulge bracket banks are here at home: Goldman Sachs, JP Morgan, Citibank, Bank of America. Therefore, even China is the biggest foreign creditor to America. The bargaining power is still gripped tightly by American government. Now, we can see the graph that refers to the yuan-dollar exchange rate floating from 1981 to 2013. Because US dollar is a free currency, let's choose it as functional currency. Unlike US dollar, Chinese yuan is managed by Chinese authorities in order to support the export-driving economy. Therefore, keeping yuan-dollar exchange rate low will boost China's economy stay on the trade surplus condition to gain profits. In addition, as the graph illustrated, there are two steepened situations on particular time points. The first time point is in 1990. Yuan-dollar exchange rate depreciated from 3.7 to 8.7. Obviously, the exchange rate was influenced by Deng Xiaoping's reform in early 1990s. Afterward, the exchange rate was continuing up and down between 8 yuan per dollar to 9 yuan per dollar. The second basic time point is in 2006, that 10 years after the plateau. The exchange rate was ascending from 8.3 yuan per dollar to 6.2 yuan per dollar. The result is that the high exchange rate harmed the export-oriented Chinese economy and reflect on slowing down the economic growth rate. Then, let's look at the inflation rate of China from 1980 to 2012. The thing I'm going to elaborate is the time from 2004 to 2012. Obviously, we can see there is an alternate highs and lows of inflation rate appear over time. The low point that about 0% is in 2006, approximate 1.5%, and consequently rising up to an all-time high to 5.9%. Compared to the inflation rate in 2006, that is 1.5%, now in China, the inflation rate is up to 2.7%, which means increased by 68% since 2006. In the meantime, the GDP growth rate decreased 26%, which was 10%, and 7.4% right now. At the same time, the exchange rate accelerated from 8.3 yuan per dollar to 6.2 yuan per dollar. In other words, China's yuan appreciated 25% since 2006. Now, let's back to our topic, the debt. China is a high-saving country, and Chinese GDP per capita increased fastly in last 10 years. However, the domestic inflation rate largely undoes the effects to some extent. The Chinese yuan is an important influence for U.S. in the capital of investment. The attempt of foreign investors to invest in U.S. economy and purchase U.S. public debt has helped U.S. real interest rate low because U.S. dollar is the trading currency and all assets in United States are dollar denominated. Chinese yuan has to exchange into dollar to prepare to use. And the exchange rate at that time was 8.3 per dollar. Even though all the following debt was based on higher exchange rate, the average exchange rate of all the debt China's government holds is much higher than the spot exchange rate. So there's a question, what is the consequence of the exchange rate float? China's capital was wiped up partly. And how? $1.3 trillion debt with the exchange rate 8.3 yuan per dollar. Now, the maturity exchange rate is 6.2 yuan per dollar. In other words, how much the exchange rate goes up on Chinese yuan, that is how much Chinese investor lose in the spot market. Actually, that is 25% value wiped up. On U.S. government's perspective, it is a good deal because you borrow more and pay back less. On China's government perspective, it is a nightmare. However, for Chinese investors, there are only few options other than keep investing in U.S. dollar assets, since China is the largest foreign exchange reserve country. All the debt is not bringing bargain chips to the table. It has rather leverage. As long as China holds down the value of the debt as what is happening, it damper U.S. demands for Chinese exports. We have already talked about the upward spiral of inflation in China. So no export means the economy will goes down rapidly. So is U.S. debt held by China's government a national threat? Obviously no. Is it a serious problem to China? Yes, it is. It is a critical translation exposure to China.